Well, welcome to everyone tuning in. Thank you very much for joining us today. My name is Glen Goland. I'm a senior wealth strategist at Arnerich Massena, a Portland-based investment advisory firm, bringing our unique and disciplined process to private clients, nonprofit endowments, and foundations. Today, we are here with guest and good friend of the firm, Adam Clough, Director of Insurance Planning at Bridge Life. Given the significant movements in the interest rate environment over the last year or so, it's important to review our insurance policies to make sure they're still meeting our needs. It's been over a decade since I maintained an active insurance license myself, so this quarter we thought it would be helpful to reach out to an expert in the field and ask him about how these rising rates are affecting today's marketplace. Adam is a longtime friend of the firm. He's helped many of our clients review their insurance policies. He's also a new parent and a heck of a guitar player, so we're grateful to have him here. Adam is here to talk about some of the things to look for and look at some different options to consider as you review your policies in this higher rate environment. Adam works with Bridge Life here in Portland, Oregon, which is specialized in helping high net worth families and their advisors create personalized wealth transfer plans and life insurance portfolios that protect assets and legacies well into the future. Adam, thank you so very much for joining us today.
Thank you, Glenn. Glad to be here.
Can you start by giving us just a quick bit of background on you, your team, and your expertise and that sort of thing?
Sure thing. I'm an advisor at Bridge Life. We are a life insurance specialty firm with offices in Portland and Denver. We're part of a group called the M Financial Group, which gives us access to special products priced specifically for high net worth families. And our firm is a specialist in the space. We design and manage life insurance portfolios for affluent families in the context of their estate and business plans. We're an advisor-centric practice, which means we're highly focused on collaborating with the client's other advisors on life insurance planning topics.
Awesome. Well, the topic we wanted to talk about today was interest rates. We've seen interest rates rise dramatically since about November of 2021, when the Fed indicated they were going to start tightening. What does this mean for insurance broadly, and why should it spur a review of folks' policies?
Well, in general, rising interest rates is largely good news for both insurance companies and buyers of policies. Essentially, insurance companies are money managers. 80% of their general accounts are held in bonds and mortgages, kind of as a rough order of magnitude. So insurance company returns are highly correlated with interest rates. Over the last few years, as we've all been paying attention to interest rates and wondering when they might start to tick up, insurance companies have been highly focused on this in attempting to transition from older, lower yielding investments into more recent higher yielding investments. So there's a bit of a market timing dynamic with the companies as they are money managers. Some companies will time the market right and have a long-term advantage with owning the right duration investments, while others will time wrong and their investment results will lag. For buyers of policies, the increase in rates means that insurance companies are pricing more investment earnings into policies. So very recently, within the last quarter or two, we've actually seen reductions in premiums, which is good news for buyers of policies. So we're finding some opportunities to improve policies and some examples where it makes sense to keep current policies, but it's important to be comparing multiple companies in any comparisons and just getting an updated projection on the current state of a client's insurance portfolio.
Got it. It's interesting. It's not that different than what we've seen in the banking side of things over the last few months, right? Silicon Valley Bank made all this news. And when you dug a little bit deeper, it really came down to mismanagement of bond duration. So it's interesting to hear you say that they've got some of the same potential sort of duration issues going on the insurance side. What are the things that clients should be looking at when they themselves are either reviewing their policies or they're looking at new policies or reviewing their overall insurance portfolio right now?
Well, more than 90% of permanent life insurance products out there are what I call floating rate products, if you made an analogy to the mortgage business, meaning that the insurance company has a right somewhere in the fine print to make some adjustments to the policy on an ongoing basis. This could either be pricing levers that they could pull or a pass-through dynamic where future results are passed through to the policy owner via some kind of an adjustable mechanism, such as the dividend. Many life insurance policies are older. They have older rate assumptions and older mortality assumptions built in. So companies may have made adjustments with these mechanisms along the way that if you haven't gotten a recent projection, it may have gone unnoticed. So it's important to reproject with current assumptions, both investment and interest rate assumptions, as well as mortality assumptions, to make sure that the policy is performing in line with expectations. Also, other things have changed in the last 10 years or longer. As life goals and the planning environment changes, it's important to make sure that your insurance is up to date with planning, the tax environment, any health or family dynamic changes, to make sure that the insurance is meeting the goals that it should be set out to meet.
That's a really great point. We have a number of clients that we've come across over the last few months that have insurance policies that were set up and they were designed to pay the estate tax due on the second spouse's passing. And they were set up in a time when the estate exemption was like $3 or $4 million, right? And today it's 13. So we've got a lot of clients that are scratching their head wondering why those old policies are the way they are. Are there particular strategies that you're recommending currently to clients, Adam?
Well, first, I would recommend just taking an active approach with annual reviews, updating projections on a regular basis, making sure that there's no unexpected surprises with the way that policies are performing. Looking at existing policies is a key part of that. When our firm reviews existing policies, roughly 80% of the time currently, we're finding that the existing policy is actually in pretty good shape, worth hanging on to with some tweaks and adjustments to make sure that it's matching the client's updated goals. But roughly 20% of the time, either due to the interest rate or the pricing environment, there's an opportunity to improve the policy with a new policy. So getting ongoing consistent reviews, updated projections, and looking at the policies is an important practice for permanent policies. To the degree that the client is looking forward and curious about what could happen with their estate or with estate tax policy, term insurance can be a low-cost, high-flexibility option, especially with something called a conversion right that allows the client to save their current health status and convert up to a permanent policy in the future without underwriting at that future point in time with an unknown future health status. So that can be a wait and see strategy that we're seeing in the current environment with some tax policy uncertainty that a number of clients have taken advantage of. Also, to the degree that the client needs death benefit in their planning, guaranteed policies can be extremely competitive with non-guaranteed options. So it's always important to do a risk versus reward evaluation and have that discussion be on the table when comparing what elements of a policy the client wants to have guaranteed versus what portions are willing to have that floating rate, non-guaranteed dynamic inside the policy. And then lastly, diversification between companies can be important. Our average client owns contracts with 3 companies. I mentioned above a few minutes ago that insurance carriers are really money managers and there's a market timing dynamic. Some are going to get the timing right and have a long-term benefit, which would then positively impact policies owned with that company. Some are going to get the timing wrong and own securities that are going to put them at a detriment to the market, and that would be a negative dynamic for owners of policies with those companies potentially. So having the risk spread among multiple companies, having some guarantees can really improve the likelihood that the client's policies looking forward are going to meet their needs long-term.
Got it. Well, hey, thank you. Thank you. I think what I'm hearing from you that I think is critically important for me to bring back to my clients is that these changing interest rates are really changing a lot of the math that we don't usually see the insurance companies doing. And it sounds as though there's been enough changes, certainly on the tax policy side of things, but also with the interest rate environment, that folks at the very least ought to reach out to their broker or their agent and say, hey, let's dust off this policy and take a look and make sure it's still meeting the needs that we set up initially. In the event that folks want to involve you in that conversation, Adam, what's the best way for folks to find you? How can we contact you?
Thing, and I'd be thrilled to be a resource anytime it would be helpful to your clients, Glenn. My phone number is 303-952-0501, and my email is adam@bridgelifellc.com.
Excellent. And for our listeners, you all can be assured that everybody here at Arnerich knows Adam really well, and we can certainly put you in contact with him as well, if that would be at all helpful. You can certainly feel free to visit our website anytime at arnerichmassena.com, and you can check out our blog for more interesting podcasts and articles on relevant topics. Thank you, Adam, for being here today. Thank you for your friendship and for the service that you're providing our clients. We appreciate you. And thank you to our audience for joining us.
Thank you for listening to Arnerich Massena's podcast. Please see the podcast description for important copyright and disclaimer information.